Hey traders, going into the week of 25th of January, 2026. Last week, the VIX moved from 19.94 to 16.08, indicating a meaningful compression in implied volatility and a shift toward a calmer, risk-on market environment, with reduced demand for downside protection and improved short-term sentiment. The U.S. 10-year yield sits at 4.231% versus 4.227% last week, pointing to virtually no change in yields, reinforcing a stable rate environment with no meaningful shift in bond market expectations. TLT is trading above a rising 30-week SMA, signaling a stage 2 environment and indicating that the intermediate-term trend in bonds remains constructive. Option sentiment data shows the total put-to-call ratio closed at 0.88 versus 0.70 last week, while the equity put-to-call ratio held steady at 0.58 week over week. This suggests a modest uptick in hedging activity at the broader market level, while equity investor sentiment remains stable and not overly defensive. The percentage of stocks in the S&P 500 above their 50-day moving average stands at 66% versus 71% at the end of last week, signaling a modest loss of short-term breadth, though participation remains broadly healthy. At the same time, the percentage of stocks in the S&P 500 above their 200-day moving average is 66% versus 67%, implying that longer-term market breadth remains largely unchanged and supportive of the prevailing intermediate-term uptrend. Additionally, 66% of the index constituents are in stage 2 advancing phases, reinforcing the view that the market's intermediate-term trend remains constructive despite short-term breadth fluctuations. Key takeaway: this is a selective long-week focus on strong stocks in strong sectors, i.e. energy, materials, consumer staples, and industrials. Stay aligned with the trend and avoid forcing shorts in a market where breadth and participation remain constructive. This is data vesting, trading with science, not emotions.